very much looking forward to this panel, Wiley. This is the hot topic, Wiley. You gotta, this is what everybody wants to know. How long will the container ship market run? This is a serious hazard here.
Yeah.
We do continuous or one by one?
Let's do all together.
Yeah, together.
COVID's over. I had it last week from Greece, but it's over.
Oh, yeah.
I did. Yeah, it's over for a while, at least for me.
Yes, this thing is on. Okay, so container ships. We spent some time, first of all, I'm Wiley Griffiths, Morgan Stanley. I cover the maritime space among others, but the maritime space is by far my favorite space in the transportation swath, so I'm happy to be here.
Sure.
And I'm happy to be back. It depends on the quarter, but I'm happy to be back in person and importantly with these guys. And it was interesting when we were in Posidonia, as people talk, as they always do when you're in Greece, about like what's the forward look for each one of the sectors, I felt like the container ship owners were not saying much about the future. They were enjoying the ride, things were good, but I never got any consensus about the future. Everybody in tankers was like, it's going up, just a matter of when, a variety of different, kind of prognoses. But containers is one that I think is hard to figure. And as someone who covers the transportation industry broadly, UPS, FedEx, Amazon, et cetera, the supply chain has just been completely top of mind, I think, for all of us, and the container folks are in the middle of it. So I will go through with Ted and Tasos and Will, maybe just briefly intro yourselves and your company, and then we'll keep it an open conversation. And I promise I'll be kind.
So I'm Ted Petrone, Vice Chairman of Navios Maritime Partners. If you don't know Partners' history, we now have a diversified fleet of basically 50 containers, 50 dry, 50 wet. So if I start going off into wet and dry, you kick me, Wiley. But we've consolidated. We like a diversified platform. We think the whole will be greater than some of the parts. But we stepped into containers in 2017. We got lucky, hit the bottom of the market. You never really aim for it. And then we've seen things just really move in a way that we haven't seen since 2004, 2008, all of us. And that's why nobody was talking in Greece, because everyone's shipping is superstitious, and you don't want to say anything when you're in the top of the market, or perceived top of the market.
Hi, everybody. I'm Tasos Aslidis. I'm the CFO of Euroseas. We are one of the smaller container owners and operators. We have a fleet of about 18 ships on the water, and we have recently embarked on a 9-vessel newbuilding program, focusing on the feeder sector, and we bill ourselves as being one of probably the only company listed in the U.S. Focusing on the feeder sector.
Hi all, I'm Will Kostlivy. I head up corporate development and IR at Atlas Corporation. Atlas is an international asset manager, but you'd most likely know us as C-SPAN. About 200 vessels fully delivered. We're going through about a 70-vessel new build program right now.
Perfect. All right, so again, we'll keep it a conversation, but I think all jokes aside, including I like the no-hitter superstitious reference, the order book is large, and so, and I think everybody talks about order book, or they talk about some sort of black swan demand event. As you think about the order book today, is that something that, the yards are too full, so it's not a big deal, or is that a big deal? It's just a matter of time. It is what it is, but how do you guys think about that when you're planning your business? Maybe I'll start with you, Ted.
Well, I just as a general overview of the industry, usually when things get very high, we overbuild. We always overbuild. It's cyclical. And by the time the ship's delivered 2 years later, you're on the downturn, and it accentuates the downturn, and then there's a crash. I think this time we're basically being saved from ourselves by the IMO regulations. I think containers at 28% is concerning, but it's not 80% like dry and containers were 15 years ago. I think, remember, with IMO regulations, let's say ships last 25 years. That means you need a 4% replacement every year just to stay even. You have 10% of the fleet is over 20 years of age. So there's a lot of things behind the scenes that tell us, listen, we may not stay at stratospheric levels, but I think we'll be above the industry average for the next few years coming. So it's a bit of a concern, but not much.
Okay. Yeah, maybe Tasos, if you have just your view. Let's do. That's a big one. So maybe we go across the group.
I think I would like to point out that indeed the order book is worrisome a bit. It's not as big as it was 15 years ago when in the previous peak of the sector. But it's also a bipolar order book. I think if you break it down in the feeder sector that we happen to be more interested in, it's about 15% on average, while in the larger vessels above 12,000 TEU, it's about 55%. I don't mean to imply that the smaller ships are immune from the order book of the larger ones. There is a trickle-down effect all the time, but they are somewhat distant from that, and they might have to face a little different dynamics in terms of demand and have a better wave to deal with over the next couple of years.
Yeah, I think from our perspective, there's the order book's definitely somewhat concerning. You look at the numbers, I'd say there's another 10% of idle capacity above 8,000 TEU. But obviously, with our model is to contract, but it doesn't, to answer the broader question, when we talk to our customers, their orders are really, they're baking in their capacity and their needs. So I think it's going to depend on where along the class structure the orders are. So we're not too concerned for us, but definitely it's going to be interesting to see. But if you also look at, environmental regulations, you see them slowing down. 1 knot can make a massive impact on the capacity required. So I think it's one of the things we'll see in the coming year and two.
Yep.
Yeah. I think, we were happy. We had stepped in and done the baby Panamaxes, and as you said, there was sort of a barbell. 67% was over 13 TEU. There was some of the smaller ships being new buildings. But now the middle's being filled in, right? 77s, there's a whole bunch of those coming in. So it's going to be it's going to flatten out the curve. But again, we're not that concerned about it's concerning, but it's not.
Yeah, and I'd also just add, I'd look to you gentlemen, because you've probably been around the industry a little longer than I have. But the investment over the last few years seems to have been, lackluster, and we're just now replacing some capacity that needs to be updated.
Especially with the new regulations coming in. I think that's a big thing that's, again, I just think we're safe from ourselves. Thank the Lord.
So as you think about your customers, the liners, they are in such a different place than they were a few years ago, both from a balance sheet perspective, from a concentration perspective. What do you notice differently about them? What I notice is they're now on every one of our buyers list for anything we're selling because they're proliferating into all kinds of things. They're also have, deep pockets to buy ships. So, question is, what is the role of the tonnage provider, in that condition or in that era? So what do you notice as you deal with your customers when you're rechartering or just in typical day-to-day kind of relationships?
As a general rule of thumb, the liner services will go to the tonnage providers and they will sell the vessels that are getting a little bit long in tooth, and then they'll do a sell leaseback, and so they usually raise capital, right, to fund their growth, which you probably don't need at this point. But still, they're also, if then they plan it very well, they'll be having a certain percentage redeliver every quarter on time charter, so that if the market goes down, they can sort of reel in their fleet a bit. So listen, they got a lot of cash. They're buying planes, they're buying everything, and we all know cash can move. But I think they're in a good position to dictate. Although I think right now, I think it was above 50%. Now it's below 50% in terms of the us tonnage providers being percentage of their fleets. It hasn't moved that much.
Yeah, I think definitely their model is to have some capacity owned, obviously, the most important assets to carry the main trades, but rely on independent owners like us to fill the gap, and to a great degree, actually. One other observation about the liner companies is they are making more money than us these days. So looking at their balance sheets, we feel safe with the contracts that we sign with them. And also, for the first time in the recent years, they got scared about being left without tonnage. So that's why they extended medium and longer term charters to even feeder size vessels. And that helped companies like Euroseas and our peers to fortify their balance sheets from the possibly weakening in the market over the next several years.
I'd say from our perspective, it's definitely an advantage for them with the cash balances they're sitting on. That being, so it gives them a bit of leverage in negotiation, but Ted's point, whether it's 60-40 or 50-50, it still makes good business sense for them to contract with tonnage providers. And then it becomes to what you mentioned, where are they allocating their capital? Is it worth it putting it all in steel or having someone else finance those vessels and take the residual value risk, like us, where that's what we do. And if you look at what they're doing, so we spend a lot of time looking at each customer to understand their needs. So when we speak to them, we can work with them. Some of them are investing. They're competing with the logistics companies who you've seen sort of grow, and they've sort of been caught in the middle and cut off to a certain extent from their customers in that touch point. So if I'm in the CFO's seat, I think, where do I want to allocate that capital? And I think some of the other ones, will look to dividend out to whether it's family or the public shareholders. So it's going to be a balance, and I think it's to be seen.
I think for the first time in a while, the tonnage providers had a little bit of leverage here. For example, I think only 20% of the tonnage providers' fleet comes off in the next 18 months. So everything there's always reversion to the mean, and then when things revert to the mean, I'm not saying it's only going to go back to, the SCFI is going to go back to 1,500, but I do think you'll get to a more normal market, and things will get back to where it generally is with providers doing the same.
Willie talked a little bit about return of capital, so I'll just raise it with each of you. And maybe just more broadly speaking, this is considered a good time in the industry for you guys over the past couple of years. Future less certain, but doesn't look like it's, we have some runway still if you look at the yards. How do you guys think about, what have you been doing proactively differently at, I won't call it top of the cycle, but during the good times to manage cycles? It's more of a leasing business. We're not talking about spot tankers here, but how do you guys think about it?
It's a different type of opportunities that one has to look for at the peak of the cycle. I mean, you cannot buy a vessel on spec and hope that you can earn the short-term rate. So the deals that we're trying to do is either deals that the vessels we buy are chartered at levels that at the end of the charter remove any residual value risk, get the vessel down to historical average scrap prices, or look at possibilities where you can pay a little less than the peak values. And those we found were the new buildings, where the prices increased, but much less over the historical average than second-hand prices. Of course, there is no free lunch. By placing a new building order, you take some exposure of what will happen in the market until you are able to fix the ship. But again, the exposure you get by paying by the price you are paying is not at the peak levels. It's significantly less compared to historical average. It's less than the peak compared to historical average.
Yeah, I think that we probably, if you follow partners, we've done a number of deals. Listen, you could do good deals, the bottom, top, middle of the market, but like we've done, if you're doing container deals now, you're not going to do without coverage. You're looking for double-digit returns, you can get it. I just say, again, I just always go back. I grew up in dry, we went to tankers 15 years ago, and now we've been in containers, and it's a much different animal. The long-term deals are more readily available, which is amazing because, the only way you got into long-term deals on dry and wet was when inflation was happening in the 80s. And I think some of this may be related to inflation pressures that they see, but I think it's just a normal course of the beast that we're going to the yards, we do the yards, and we're getting deals. Again, I'm just surprised coming from the other side of the industry that you can do these long-term deals. But this is the trade that happens. I mean, these guys know better than I do in containers. It's like bus stops, so people need this right equipment coming in all the time.
Yeah, from our perspective, I'd say that the way we price things and underwrite is we really do a bottom-up analysis. So wherever the freight rates are a little less, we view it as it will shift towards the price of the new build from the yard. So we manage that. We're looking to optimize our fleet. We've announced divestment of some of our Panamax class vessels portfolio. And then we're a little different given the Atlas structure. So as we've got our growth built in, and once we see those cash flows flow in, we'll look to allocate that to other sectors that are counter-cyclical. So always trying to manage that cash flow and where the market is, but definitely seeing some compression in the rates, but hoping that will flow through to the yards.
I mean, when you can get the vessel, as you said, back down to scrap within under 10 years, why not?
You can get them within scrap value even with shorter charters. I mean, the couple of deals we've done with second-hand vessels, we believe they're going to bring our cost base below historical average scrap prices, not current scrap prices, within 3 or 4 years. Then the other thing you need to do at these good times is to see how you're going to deal with the cash and the capital that you are accumulating. I mean, we try to renew our fleet and sort of prepare the company, a central fleet for our company for the next decade by placing the new building program. But then again, over and above that, you need to see whether you're going to distribute cash to the shareholders, help your stock, or retain certain power to dry power for the inevitable, I guess, drop of the prices.
Do you, just on the topic of cash flow and dividends, obviously container ship or container ship leasing, tonnage providing, whatever you want to call it, does, to Ted's point, you got charter cover, you have real cash flow, you can lock in effectively ship by ship deals, and financing has been pretty readily available. Investors always want return of capital. You'll get that in 2 out of 3 meetings. How much are the drumbeats louder in this environment? How are you engaging with investors on buybacks, dividends, et cetera? So it'll be different for each of you because you have technical aspects that are different, but I'm curious.
So I'd say for us, obviously about 70% of our stock is held by 2 shareholders. And no one's really pushing us to increase the dividend. Obviously, we want to maintain it. We view ourselves as infrastructure-like, so it's an important component of returning capital to shareholders. But as we see our new fleet roll on in 23, 24, we're looking to utilize that capital to reinvest and continue to grow, whether it's in shipping or in energy. And from a share buyback perspective, we're always looking at what we can do to optimize the price. But given our free float and liquidity, for us it's a little more tricky of a calculus to figure out to ensure we already have a very low average daily volume. So buying back, from a capital markets perspective might not be the most useful or helpful action, but always, monitoring market conditions.
I think we try to pursue a balanced approach, give some dividends. We reinstituted dividends last quarter, and we have enough contracted cash flow and visibility, and we believe we'll be able to maintain it at least at the current level for the next 3 years. So that's one way of how you use the cash flow you generate. Another is we see potentially at a share buyback. We can talk, I presume, a little later about how all the container ship companies are undervalued compared to their contracted revenues and intrinsic value. So that appears to be the best investment for you to buy your own stock these days. So we have initiated a share buyback program. You try to renew your fleet a bit, and we're doing it with our new building program. And I believe we're going to be able to retain some cash to be able to attack other opportunities should they appear.
Well, apologies to those who came here to listen to a full container discussion, but we're a little bit different. So we, being a diversified platform, are using the money we're getting from containers to get involved in tanker industry. We did a big deal with Chevron to Aframax. So it's cross, segment opportunities that we're looking at. We also got a dividend. Obviously, people want to see it higher. They always do. But we're looking at total value. We think the stock price will go up. We think the model will prove itself over time. And as everyone else does, we're always renewing the back end of the fleet. Our goal has always been to be 1 or 2 years below the industry average on a cross section. And we're always deploying capital. We're not looking to grow just to get numbers. I mean, Partners 150 ships. but we're looking to grow accretively. So accretively is if you're doing container ships today, you're doing it with coverage. Tankers, you probably don't want coverage. You probably want some short-term coverage, and dry, you'd probably want to start looking at some period coverage. So it's a mixture, but at least the cash is there. We're not a leveraged tanker company not being able to spend at this point.
Yeah, yeah, and you guys obviously, like you say, have a diversified group, so there's ways to manage that, which is different. What is, as you guys, we all heard about operational issues during COVID, and Ukraine has put tensions on certain parts of the networks. What is the operationally, or what are the things that are concerning you guys as owners of ships in this market? This is a very strange time in the world. I won't say COVID's over. I do occasionally, but we're kind of getting into the point where we don't know what's next. There's going to be the supply chain reconciliation at some point. We don't know the pace of that. Operationally, COVID issues have eased a little bit, but what are your technical people, your operational people, or just the major strategic concerns that you guys are grappling with the most in this period of volatility?
I'll go. Oh, go ahead. I was going to say, from our operational folks, the biggest concerns have obviously been lube oil pricing, right? How do you hedge against that? Crew changes, which I think we've sort of covered right now. I mean, I think at the beginning it was a little more difficult, but our ops teams have figured that out. And then the third is really crewing to a certain extent. With the Ukraine crisis, I think it's around 20% of the seafarers are from the Ukraine, but I mean, you can source talent from other countries, but in our experience, Ukrainians tend to be at the higher end, of the crew, captains, first officers. So that's been a bit of a challenge in training, replacement crews. But again, I'm not the ops expert, but that's sort of the key challenges they faced.
I think what Will said, there are all the key issues that we are facing. I think in terms of key success factors is clear that you need to keep your ships operating. We have entered into these contracts that provide us with pretty lucrative rates. The condition is the ships has to be running. So you have to make sure that there are no hiccups in the technical side of the vessels, on the operational side of the vessels, make sure prevent accidents and all kinds of things. So it has become more of a critical thing to have your ship running. A day that the ship is not running for whatever reason, it could be, in our case, at some point, it was $200,000 a day. So that's an important success factor, I think, looking over the next 3 years for the companies.
Yeah, I think the same with us. I mean, we own most of the ships that we have, and so we have 3,000 people on the water every day depending on us. We completely revamped our operational and communications with the ship. We got them to call home more. We got the provisions no matter what the cost was. Being out, I had sailed 1,000 years ago, and even with today's communication, it gets very lonely when you don't know how your family is. So we were very concerned about crew and safety, and of course, bringing the cost down of just crew changes during the height of the pandemic. So we did a lot of changes in home. I mean, we had different, people in shifts. There was always somebody that can answer the phone when the captain rang. So we were very concerned about safety, and obviously, as you said, you get one person going into a particular country and they shut the whole ship off for 2 weeks, and whose cost is it, that type of thing. But we really were concerned about people. We had medical teams in our office in Greece because we have 300 people. We had doctors visiting our ship, so the crewing was a big concern for us for a long while.
And just the other point that we grappled with, not in a bad way, with some of our customers obviously looking to do deferred dry docking, when the rates were high, and our commercial team obviously needing to push back a bit to ensure, met the requirements.
Yeah, makes sense. I mean, in a different way, just a read across to the airlines who are so short of pilots, yet the financial guys want to push capacity. It's the usual. What about the then and now on access to capital? From a public markets perspective, I'm not doing many IPOs these days in any sector, and the bond market's watching interest rates. So public markets feel tough. But the bank markets feel pretty good. You know, if Posidonia and the number of, you know, credit coverage officers attending is a barometer, that felt pretty good a couple weeks ago. Do you guys feel like from an access to capital, access to credit perspective, it's same, better, worse relative to pre-pandemic?
I can say for a company of our size, it is the same or better. I mean, when the banks love when you make money, and when they love you, you don't really need their money in some sense. But still, you have to follow a balanced approach. I mean, we are partners with our banks, and we want to be with them in the good times and in the bad times. So we are trying to maintain, again, a balanced approach to finance our ships and increase the liquidity we have, and through that, increase the capacity we might have for additional projects. So it is not an issue, the financing these days for if you are on the ship owning side, but you need to have it in mind also for the subsequent phase of your life.
I would say that Europe sort of opened up a bit, but also remember the Far East, there were a number of companies and countries that were making a lot of money. And so you go where the financing is, right? It shifted to the east for a while. There was a lot of sale and leasebacks being done, a lot of loans that were, I would say, not on Western type terms, which is probably good for many of us. So you just, you know, for the Americans here, Willie Horton was a famous bank robber in the 30s. And he said, what are you robbing banks for? He said, because that's where the money is. So you go where the money is. And it's always moving around. You know, it's different parts of the world will open up and close. And bond market opens, stock, you know, equities close. So you're always got to feel out what's out there and where you can go get the capital.
I'd say from our perspective as well, I agreed. I would go a lot to the Far East. There's no shortage. Obviously, we just closed about $6.9 billion in committed financings. Utilize JOLCO, ECA structures. So the capital's there and the rates are pretty reasonable, and I think that it's not going anywhere if you utilize some of these specific structures and financing vehicles.
So maybe with the last, 5 or 10 minutes, each of you can discuss. It'd be good to kind of differentiate the companies you work for a little bit and talk about, how you differentiate it in front of the equity or the credit markets. So maybe just spend a couple minutes each on that, and then if there's time, we can open it up for questions. But maybe we'll start with you.
Certainly, thanks, Wiley. I don't want to bore people here, but we sort of look at our business as customer relationships. We spend all the time, whether from ship design to scrapping, we work with our customers. We're very close to them, understanding what they need. We'll design the ship. Often we'll build some ships for them. They'll be building the yards, some sister vessels. That's really our value add. We're working closely with them on future fuels. I think we're doing about 29 LNG dual fuels, but working with some of the other liners on designing and working with the engine manufacturers on future fuel able vessels. And I'd say that's really where we play. And we also sort of right now focus on the largest liners, mainly the alliance members and a couple of and ZIM. And so right now we're pretty confident with that credit profile, and that obviously helps our financing as well.
Euroseas is focusing, as I mentioned earlier, on the feeder part of the market. It is a company that has been in various forms, or the family that behind the company has been in shipping for the last 150 years, so it's a long presence. We followed a slightly different approach compared to Navios. We used to have bulkers and container ships, and we decided to spin off the bulkers 4 years ago and make Euroseas a pure play on the feeder vessels. Typically, we had medium-age ships. This bonanza in rates allow us to pursue a significant fleet renewal strategy. So we're building a company that would be focused on the key commercial feeder sizes over the next 5 to 10 years. And we'll try to build based on that further with opportunities that appear in front of us.
Yeah, again, so we're a little bit different. We've just sort of done a bit of the opposite. And that's shipping, right? Everybody has a different view. We went public in 2005 as a dry bulk. We then had other sister companies, but we realized that my joke to your bankers is if you had the volatility in banking and the stock market that you have in shipping, you guys would be jumping out of buildings like it's 1929 every other year. That what we decided to do was put it all under one umbrella, modify the volatility, get some cross-segment opportunities, and prove that over the long term, a diversified platform works better than a pure play. We'll find out. We were kind of forced into that by the way the market drove us, but necessity is the mother of invention, and we've been brought to that point. I think what we see going forward. We got involved in some tanker deals just now. Now we wish the asset prices were lower, but they've been held up by the, listen, if you look at the order books outside of containers have filled up, right? That's why you have 20%. But the wet and the dry, you're at 5-6%, and you're down 40-50% on yards. So we're very confident in the future. It's a matter of, the problem is, if you go back in history on any shipping company, in any segment, the worry is you lay your seeds of destruction in the top of the market because you do things you wouldn't have done because you've had too much success. I tell the traders on the floor, your worst deal is going to be after your best deal because you think you're bulletproof. And the same things happen to organizations, and that's why we're trying to guard against that and be quite cautious at the top of the market on containers.
Great, super helpful. That's one of the cool things about shipping, and I've known Ted and Tasos for over 15 years. Will I've only known for a couple years, but he's based in Vancouver and Canadian, so he's good by me. But they all do, they have the same strategic dilemmas in front of them, and they all operate differently and have different strategies, and it can be successful. Any questions for the panel?
Yeah, thank you guys for a great panel. I just a question on valuation. I know there's like sort of chronic feeling like your companies, you don't feel like they're adequately valued. Just would be interested to hear your comments on that and kind of what you think you can do to sort of improve that situation.
Sure. Since we're a pure company, pure container company, let me take the answer first. So it's very easy for me to come up with some estimates for valuation estimates for Euroseas, and I think the same applies for all our peers in the sector. I think we have sufficient contracted revenues with visibility well into 2024 and even 2025, that if you take just the contracted cash flows, the contracted revenues, charge against those all the costs that our entire fleet has, if I do the calculation for my company, and I'm sure it's the same for everybody, we come out at about $30 a share. Right now we're trading at 25. On the top of that, one needs to add the contribution for the uncontracted days, of which the cost you already accounted, so that would be some number. I mean, I estimate at least $10, $15 per share. And on the top of that, you need to add the residual value of the fleet at the end of the 3-year period that I'm doing the calculation over. So it's easy to see that all container companies are way undervalued right now. The question is how you can communicate that to the investors and what it takes for people to believe that this is realizable.
You got to ask him.
It's a question for you.
That I don't have the answer to.
I just want to say one thing. Cut and paste what you said to Navios. It's the same exact story. We have to convince the show. The problem is the street usually runs hot or cold on the shipping industry. And so we got to get him to be lukewarm and to follow us over a longer period of time.
Well, and I would say the pitch on shipping in the late 2000s was a pure hedge fund pitch. It was truly momentum. And I think now the reality is it's a lower for longer business. And that suits the market, but there is some re-education involved.
I think you had a lot of people investing in 12, 13 in a lot of segments, and they've collapsed the market. And all of us, containers, dry, we went through a decade in the 2010s of not making any money at all, hardly, and scratching around. But we chewed through the overcapacity on all of them. And then the pandemic hit, and we thought, what the hell? But it actually, unfortunately for us, became a blessing for shipping because it disrupted all the supply chains. And just-in-time inventory is now just-in-case inventory. And so we live off inefficiencies, and I do think the IMO will cause slow steaming. And if you're going to maybe talk about, I know we're over, but you're going to say, what are you talking about next year? It's going to be fleet speed. It's going to be, hopefully it's not going to be war and pandemic.
So I think that is the good caveat of our discussion, that the sector might face headwinds because of the slowdown on demand and the high order book, but all the companies have sufficient contracted revenue base to withstand that. And in addition, the environmental constraints that are being imposed will definitely, or very likely, decrease the fleet supply. So will make the headwinds less severe.
Decreased fleet supply by lower speeding
By
and
lower
picking up scrapping for some of the older ships will not be able to make the incremental, yes.
Yeah, that headline 25% is not the only variable.
No, that's right.
Great. Thanks, everybody. We've run over time, but thanks for being here in person, and thanks very much to the panel.